Hello everyone, I hope you guys are doing well and studies are going in full swing. So in today's video, we are going to do a complete and a detailed revision for IND AS 38 on intangible assets along with its important questions in the best possible time. So let's get started. Now, there are three important areas in the standard that you should be clearly aware over and above what is the general understanding for a tangible or intangible asset. That is, first, how do you understand what is an intangible and how does it get recognized in the balance sheet? Second, about research and development, and third, about amortization. Other topics are largely an overlap over IND AS 16 PP, though we will discuss that as well. So first of all, when does something become an intangible and when does it make it to the balance sheet? So for something to be intangible, there has to be three important criteria. First, it has to lack physical substance, that is, you cannot touch, feel, see, like a software, patent, copyright, trademark, etc. Second, it is non-monetary in nature, that is, it does not convert into a fixed or a determinable money value. Like a bank balance is also something that you cannot touch, feel and see. However, that is monetary in nature and hence cannot be taken as an intangible. And third, which is the most important, is it has to be identifiable. For it to be identifiable, it has to be either separately sellable, that is, it is capable of being separately sold. Like when you look at a patent, I can remove and sell a patent separately without selling the entire company. Or it has to be a contractual right or a license which arises like a telecom license or a franchisee right, for example. Now, whether they are separately saleable or not, it does not really matter. So it has to meet one of these two criteria. If it does not meet, then you cannot show it separately. Like market share, for example, that Maruti garners, this market share cannot be separately sold without selling the entire business, or it does not arise out of a license or a contract, and hence Maruti cannot recognize the market share separately as an intangible. Now, merely because it meets these three criteria, can you recognize an intangible in the balance sheet? Well, it is an intangible asset, so it has to also meet the asset criteria. Like, it has to be capable of giving future economic benefit. Like research cost you might incur, but that may not necessarily give you future economic benefit and hence you cannot recognize it. Second, it has to be controlled by the entity. Like human resources in general give future economic benefits. However, you cannot own a human resource and hence you cannot show them as an asset. Further, the next important criteria for recognizing an intangible asset is cost has to be reliably measured. Now, this is the reason why most of the self-generated assets like a self-generated brand, self-generated goodwill, etc. cannot make it to the balance sheet because their cost cannot be reliably determined. So in summary, if you have to figure out whether a particular intangible makes it to the balance sheet or not, you check for 6 things. First, it has to lack physical substance. Second, it has to be non-monetary. Third, it has to be identifiable, that is either separable or capable of giving you a contractual license or a right. Fourth, it should give you future economic benefits. Fifth, it should be controlled by the entity. And sixth, the cost should be reliably measured. If these 6 criteria are fulfilled, then you can recognize something as an intangible asset in the balance sheet. A couple of special things that you should be aware of is deferred revenue expenses like major advertisements, major training, or major preliminary or incorporation expenses which are already incurred. Like ads are displayed, training is done, incorporation is done. You should recognize these expenses as when they are incurred. You cannot show them separately as an asset because they do not meet the identifiability criteria in an intangible. You cannot separate out and sell, or they don't give you a license or a right, and hence they will be recorded as an expense as per accrual as and when they are incurred, no matter how convincing they try to tell you that the benefits may be received over the future years. Remember, accrual overrides matching concept, which means if the expenses are to be recorded when they are incurred, that is when ads are displayed or when training is done, and not necessarily when you expect to fetch the benefits out of this. Okay, so this is regarding the first part. Second, when you look at research and development, there are 2 aspects over here. Research is the ideation phase, whereas development is after your idea kind of translates into an economic reality. So when you are incurring certain expenses during the research phase, like you are trying to find a cure for HIV/AIDS, you have not yet found anything and hence you are doing an expense during the research phase. All the expenses incurred during the research phase should be taken to the P&L always, no exceptions over here. However, expenses incurred during the development phase, that is, you find a molecule which can cure AIDS. However, you cannot just administer that to the public at large and hence you might incur certain other expenses. What do you do with expenses incurred during the development phase? Well, if it meets 4 specific criteria, then you can capitalize it. That is, if they are technically feasible, that is, it is technically possible to make that medicine. Second, it has to legally permissible. The government would allow such a medicine to be administered. Third, financially feasible. There is a market who will take those products and cost is measurable. If all the 4 conditions are satisfied, then expenditures incurred during the development phase should be capitalized. Otherwise, even expenditures during the development phase should be expensed. Remember, development phase ends when the intangible becomes ready for use. Now, what if you are unable to determine clearly whether you are incurring certain expense during the research phase or development phase? In such a case, the standard tells you that you should recognize the expense as research if you are unable to clearly determine whether it is in development phase or not. Secondly, what will happen if an intangible is under development? The standard says you have to mandatorily test the intangible for impairment at each balance sheet date till the time it is ready for use. Impairment testing means you will compare the carrying value with the recoverable value of this intangible asset under development and select whichever is lower. So you will continuously check for financial feasibility till the time the intangible is ready for use, because the amortization cannot commence. And lastly, what if there's an in-process R&D? That is an Ind AS 103 business combination aspect. If you were to acquire a company which has an in-process research or development, Ind AS 103 says you can take them over at fair value at the acquisition date if it is a separately identifiable item. However, after the acquisition date, Ind AS 38 will apply, and if you are continuing with the research phase, future expenses will be taken to the P&L, whereas if you are in the development phase, which fulfills conditions, then future expenses can be capitalized. That is the second part. Third part of the standard pertains to amortization. Now, amortization for intangible is similar to depreciation for a tangible. Now, when you are looking at an intangible asset, amortization over here will be subjected to intangibles having a finite life. If intangibles have a finite life, then you will amortize it over the useful life. Remember, the physical life might be different, but you will amortize it over the useful life. Like patents, copyrights, they do have a finite life. You will amortize it over the useful life. And if there is no separate data regarding the method, you can do this on a straight line method. However, if there is a systematic basis, you will take that basis. If there is no basis, then you can take the straight line basis. Now, the problem over here is what can be the systematic basis? Well, it depends on the facts of the case. However, Ind AS 38 clearly tells you that a revenue-based amortization is not appropriate. That is, you cannot amortize in the ratio of revenue. Remember, units of production is possible. That is in the ratio of output that is produced. The difficult job is selling it. You cannot amortize in the ratio of revenue. So, revenue-based amortization, even if there, is actually prohibited. However, there is a small exception where if the intangible amortizes in the ratio of revenue, that is when a revenue-based amortization can be done. Other than that, you cannot do a revenue-based amortization. So, for amortization of intangibles with a finite life, you will amortize it on a systematic basis over the useful life. If there is no systematic basis, then on a straight line basis. However, the revenue-based amortization is not considered to be an appropriate method. The revenue-based amortization over here cannot be taken as an appropriate basis for the purpose of amortization. Next is, what if there is an intangible with an indefinite life? If the intangible has an indefinite life, then you will test it for impairment annually. There will be no amortization. So, if you have a trademark or let us say some rights which have an indefinite life, well, you will not amortize them, but you will test it for impairment annually. There's no 10-year, 15-year, 20-year, 5-year limit over here. You can always at each balance sheet test it for impairment annually. So there are two things that we have studied over here, and third is there in business combination, where you will have to test for impairment annually. Intangibles with indefinite life, intangibles with which are under development, and third, goodwill under business combination. The common thread that connects the three is they are all intangible and they will not be amortized. Okay. Next is other accounting principles for an intangible will broadly remain exactly the same as that of PP. Like initial recognition for an intangible will be at cost. Cost will include the purchase price plus directly attributable expenses plus non-refundable, non-creditable taxes. If, let us say, you have a barter, then you will recognize the intangible at the fair value of the asset given up. If not available, then fair value of the asset received, and if not available, at the WDV of the asset given up. If there's a deferred payment, that is payment going at or beyond 12 months, then you will recognize the intangible at the present value of whatever is the payment to be made. Next, when you go to, let us say, subsequent expenditure, every intangible, every expenditure which increases the life or efficiency should be capitalized. However, other expenses will be taken to the P&L, like a repair and maintenance cost. Third is where there might be a slight change, where you have subsequent evaluation. You can either do using cost model or revaluation model even over here. However, the evaluation model can be applied for intangibles only for intangibles which have a market, whereby the value can be determined. Unless given otherwise, from a student perspective, if a fair value is given, we will assume that the fair value comes from a market, and as a result, revaluation model can be applied if a fair value is there. And later, amortization, as we have discussed earlier. So largely the principles remain the same. We have also given over here a kind of a summary when it comes to PP, intangibles and investment property. In PP, you can either do cost or revaluation model at your choice. In investment property, only the cost model. And in intangibles, you can take cost or revaluation, but revaluation needs to have the fair value from a market. If nothing is given, we'll assume that the given fair value is coming from a market base. Now, a separate extra thing which is not there in your ICI study material, but for your general understanding, is what happens in case of crypto accounting. Now, crypto cannot be shown as a cash because it is not legal tender, nor is it a cash equivalent. Next, it is not an investment property because it is not land or building. Financial asset, it is not a contractual right to receive cash, and hence, as we speak, till the time this definition gets amended, crypto is not even a financial asset. So how is crypto, the biggest companies like Tesla, etc., how are they showing their cryptocurrency or Bitcoin held? Generally, they are as of now showing it as an intangible because it meets the identifiability criteria, can be separately sold, does not have physical substance, and the cost, etc., can be measured reliably. So as we speak, till the time there is any amendment in the financial instrument standard, if there's a crypto, it is usually shown by most of these global companies under the intangible heading. Now, this takes care of the concepts. We'll go to the important questions now for Ind AS 38. So over here, we'll do a few questions like question number 4. Now, this is a classic question when it comes to barter. Now, we are not really going to look at whether it is PP, intangibles. It's one of the best questions when it comes to barter. Sun acquired a software from Earth in exchange for a telecom license. So, over here, Sun is acquiring a telecom software and it is giving up a telecom license. The telecom license is carried at 5 lakhs in the books of Sun and the software is carried at 10,000 in the books of Earth, which is not the fair value. Okay. Advise the journal entries in the following situations in the books of Sun as well as in the books of Earth. First, the fair value of the software is 5 lakh 20 and fair value of the telecom license is 5 lakhs. So when I look at the books of Sun, in the books of Sun, it is giving up telecom license and receiving the software. So software received will be recorded at the fair value of the telecom license given up, which means the software will be recorded at 5 lakhs. But in the books of Earth, it is paying the software and receiving the telecom license, which means the telecom license will be measured at the fair value of the software given up, which is 5 lakh 20. So when I look at the books of Earth, I will say that, well, telecom license account debit 5 lakh 20 to software credited at WDV, and the balancing figure will be the gain on barter. Remember, what you're crediting, debit what comes in, credit what goes out. In the books of Earth, debit what comes in, well, license is coming in, credit what goes out, software is going out. What is going out will always be credited as a WDV because in your ledger, if it is 10,000, it has to be credited and then 10,000. However, what is coming in should be recorded based on what you are paying. Well, the license may have a fair value of 5 lakhs. You are paying a software which is worth 5 lakh 20 and hence the cost of the telecom license is 5 lakh 20 and the balancing figure is a gain on barter. Second, fair value of software is not measurable. However, similar telecom license would be transacted by another company at 4 lakh 90. So over here, if I go to the books of Earth, the fair value of the software that you are paying is not measurable. In such a case, the second preference is the fair value of the asset received. Ideally, first preference is fair value of the asset given up. For Earth, software is given up. I cannot measure the fair value. Second, if not measurable, then the fair value of the asset received, that is 4 lakh 90 worth of telecom license. So in the second case, if I look at Earth, I will say that telecom license account debit 4 lakh 90 to software 10 and the balancing figure of 4 lakh 80 is a gain. And last, neither fair value of software nor telecom license could be reliably measured, in which case the transaction will happen at the WDV, that is in the books of Earth. Debit what comes in, telecom license coming in, credit what goes out, software going out, software credited at 10,000, telecom license being debited also at 10,000. So a similar working you can do for Sun. We have kind of discussed this for barter, where you apply the rules for barter, whether this is license and software or it is land and machinery. The principles remain the same. Next, you go to question number 6. This is an intangible which is under development. So, expenditure for a new production process in 11-12 is on 1st April to 31st December. This is 2700 and then 900. Total comes to 3600. The production process met the intangible criteria for development on 1st of January 12. The amount estimated to be recoverable from the process is 1000. Now that means any expenditure that you incurred before 1st January 12 will be in the nature of research cost and will be taken to the P&L. However, expenditure after 1st January will be capitalized as intangible under development. However, you have to compare it with the recoverable value, which is 900 or 1000, whichever is lower. And hence, this will be shown as 900 as on 31st this March 2012. Okay. Next, expenditure incurred for development in the year 12-13 is 6000, which means your intangible will go from 900 plus 6000 comes to what? 6900. You are still developing. Asset was brought to use on 31st March 13, that is at the end of the second year, and hence no amortization will happen in the second year and is expected to be used for 6 years. So that's about it. In the second year, there is no expense, but the intangible will be shown as 6900. What is the carrying value of the intangible on 31st March 12? Maybe 900, and 31st March 13, maybe 6900. And determine the charge to the P&L for the year 11-12, well, 2700 of research cost. At 31st March 14, the amount estimated to be recovered from the process is 5000. Maybe there's an indicator of impairment, and hence you are doing impairment testing. So over here, the carrying value will be 6900 minus an amortization over here. This is what? 6900 divided by 6. 1150 of amortization, and hence this is 5750. Compared with 5000, and hence 750 will be an impairment. What is the carrying amount of the intangible on 31st March 14? 5000, and charge to the P&L for 13-14, maybe 750 on account of the impairment loss. Are we clear with this? Okay. Next, you have this question which came in a recent exam as well, where you are applying the revaluation model for a patent. Like you purchased a patent on 1st April for 3 lakhs, which had a legal life of around 15 years. However, due to the competitive nature of the product, management estimates a life of only 5 years, which means you will amortize it over 5 years. That means 3 lakh divided by 5, 60,000 will be the amortization each year. Straight line amortization is determined by the management to be the best method. On 1st April 12, that is 1 year later, management is uncertain that the process can actually be made economically feasible and decides to write off the patent to an estimated market value of 1,50,000. So on 1st April 12, your patent will be at 2,40,000, 3 lakh minus 60,000, compared with 1,50,000, and there will be a downward revaluation of close to 90,000, which will go to the P&L account, and decides to amortize it over 2 years. So 1,50,000 over 2 years, which will be 75,000 each year. At 1st April 13, that is 1 year later, having perfected the related process, the asset is now appraised at a value of around 3 lakhs, which means that is a subsequent upward revaluation. Remember, there is nothing even regarding maybe a recoverable value, so Ind AS 36 on impairment is not applied. We have been given market value, and hence we are applying the revaluation model. Furthermore, the estimated useful life is now believed to be 4 more years. So we started at 2,40,000, then 90,000 downward revaluation going in the P&L, 1,50,000, 75,000 of amortization, and your balance is at 75. Now you remeasure it to 3 lakhs, which means there is a subsequent upward of 2,25,000, out of which the earlier 90,000 which had gone to the P&L will be reversed against the P&L, and the remaining 1,35,000 will be against the revaluation reserve. 90,000 against the P&L, remaining 1,35,000 against the revaluation, and hence your asset is at 3 lakh, which is to be depreciated over the remaining 4 years. That is 75,000 in each of the years. There is no further data given, and hence for every subsequent year, the patent will be depreciated by 75,000 in each of the years. Okay. Next, you have this question 10, which is pertaining to research and development. Over here, what do you have to do? How should you account for the above mentioned cost? Now, X is engaged in developing of computer software. The expenditures incurred by X in pursuance of development of software are as follows. So, whichever expense which is incurred till the time technical feasibility is established will be under research. Beyond that will be under development till the time it is ready for use. So paid 2 lakhs towards salary of program designers. This will be research. Why? Because you are still designing the program. Then you will check for feasibility. 5 lakhs towards other cost of completing the program design. You are still developing the design which will be tested. Research. Incurred 2 lakhs towards cost of coding and establishing technical feasibility. This is a cost which is incurred after which technical feasibility is established, and hence this is also in the nature of research. So total 9 lakh will go to the P&L as a research cost. Paid 7 lakhs for other cost after technical feasibility. So this is a development cost, will be capitalized. 2 lakhs towards other testing costs, which is during the development phase, and hence this will be capitalized. Now, point F is now removed by the institute because it is a little controversial. But cost of producing a product master for training materials, this is 3 lakhs. Now, earlier when this adjustment was there, any cost which is incurred to make the product master, that is the first version of the product, will be capitalized, and hence this cost will also be capitalized. Though now because of the controversial nature, they have removed it. But if it comes, you should take it. Any cost behind the product master, that is the first version of the product, should be capitalized. So over here 7, 2 and 3, that comes to around 12 lakhs. A focus group of other software developers was invited to a conference for introduction of this new software, and this cost went up to 70,000. Now this is inauguration expense, will be taken to the P&L account. On 15th March, the development phase was completed, and hence, if useful life was given for the last half a month, you will even do amortization, and cash flow budget was prepared. So basically 9 lakh will go as a research expense, 70,000 as inauguration expense, and 12,000 as an intangible asset will be shown in the balance sheet. Okay, next you have this question number 13, which is on player rights. Remember, this is a kind of a case where if you are kind of paying, let's say 26 crores approximately for getting Rishabh Pant as Lucknow team, if the terms of the contract are so stringent that even if the player wants to leave, they cannot leave without mutual consent, in such a case, you can exhibit to have control over the services of the player. Remember, you don't own the human. However, you have exclusive right to the service, and hence in such a case, the biggest of the football clubs, cricket clubs can show this as an intangible, as a right on the player's service. Here, the benefits that I get from the player is very difficult to measure. However, the cost is measurable. I know that I am paying 26 or 27 crores, as a case may be, for acquiring Rishabh Pant's services, and hence over here this can be shown as an intangible. Now ABC Private Limited recruited a player. As per the terms of the contract, the player is prohibited from playing for any other entity for the coming 5 years. So there is a prohibition, and will have to be in employment with the company and cannot leave the entity without mutual agreement. Now this clause is usually not there in a regular employment agreement where you can give a 1 month notice and leave. However, here you cannot do that, and hence this clause exhibits control over the player, and hence this player can be shown as an intangible. The player rights. Price paid by the entity to acquire the right is derived from the skills and fame of the player. The entity uses and develops the player through participation in matches. State whether the cost incurred to obtain the right can be shown as an intangible asset. Yes, it will be shown as an intangible asset because the contractual terms exhibit that kind of control. Okay, and then I would say question number 14, which is arguably one of the best questions which is there in this chapter. We will quickly try to review that. Now, Super Sounds has the following transactions during the financial year 1920. Okay, so there are 3 transactions. What are we supposed to do at the end? A schedule showing intangible section in Super Sounds balance sheet as on 31st March 2020. So whatever are the intangibles, and a schedule showing the related expenses that would appear in the P&L of Super Sound for the year ended 1920. So balance sheet mein whatever are the intangibles and whatever are the expenses. Okay, you have also been told that Super Sounds follows an accounting policy to amortize all intangibles on an SLM basis or any other appropriate basis over the maximum period permitted by the Ind AS, and a full amortization is taken in the year of acquisition. Usually amortization should be done pro rata depending on your date of acquisition, but here you have been clearly given that it will do full amortization in the year of acquisition. So let us review that with this background. On 1st April 19, Super Sounds purchased net assets of Music Limited for 13 lakh 20. The fair value of Music's net assets was 10 lakhs. Super Sounds is of the view that due to popularity of Music's products, the life of the goodwill is 10 years. So over here, should you amortize goodwill over 10 years? No. Ind AS 103 says goodwill cannot be amortized. But sir, how much is the goodwill? Well, goodwill over here will be 13 lakh 20 minus 10 lakhs, which is 3.2 lakhs, which will be shown in the balance sheet as a separate line item. So your goodwill will be 3 lakh 20, but there will be no amortization because Ind AS 103 does not permit amortization. It allows testing for impairment annually. So 3 lakh 20 will be there in goodwill. On 4th of May, Super Sounds purchased a franchisee to organize musical shows from Arman TV for 80 lakhs. So this is the initial cost that I am paying to acquire the franchisee rights. This will be a part of my franchisee rights, which is an intangible. It is identifiable. I am getting a license or a right at an annual fee of 2% of the musical show revenue. Now, will 80 lakhs be a part of cost? Yes. However, because it is linked to acquisition, even if there is no further musical show, I still have to pay 80 lakhs. However, the remaining 2% like a royalty is linked to the musical show revenue. So if there is no musical show revenue, I don't have to pay this. And hence that is linked to operation of this license and not acquisition. And hence 2% of the musical show revenue, whatever I pay is going to go to the P&L as other expenses, royalty charges. The franchisee expires after 5 years. So it has a 5-year life. Musical shows revenues are 10 lakhs for the first year. Projected revenue for the next year is 25 lakhs and then 30 lakhs for the remaining 3 years. What do you guys think? My intangible asset will be 80 lakhs. However, can I amortize it in the ratio of revenue? No sir, revenue based amortization is prohibited, and hence the amortization will be done on a straight line basis, because revenue cannot be taken as a systematic basis, and straight line basis is over here 1 by 5. Sir, ideally I should amortize it only by 11 months. The answer is yes, but if the question tells you in the year of acquisition take the full year amortization, we take the full year's amortization, and hence this is around 16, and hence 64 will be your franchisee, right? 16 will be the amortization expense which will be taken to the P&L account. On 4th of July 19, Super Sounds was granted a copyright that had been applied by music. For the year 1920, Super Sounds incurred 2,50,000 on legal cost to register the copyright. So this is an acquisition expense, will definitely be a part of the cost. And 7 lakhs as additional cost to successfully prosecute a copyright infringement suit against a competitor. So maybe this is copyright infringement. It must be after you are given the copyright, a competitor copied that, and you kind of incurred a subsequent expense to protect your copyright. So this is like a maintenance cost after the acquisition, and hence this will be taken to the P&L account. So over here 7 lakhs of additional cost will go to the P&L, but your copyright will appear at 2.5 lakhs. The life of the copyright is 10 years and you will amortize it over 10 years. Now ideally in the first year, if you are acquiring it in July, start, maybe 9 months of amortization should happen. Again, in line with the institute solution, because it is given, we will amortize it over the entire year. So this is 0.25 of amortization and 2.25. So in my final balance sheet, goodwill will appear at 3.2, franchisee rights at 64, and 2.25 towards your copyright. And in my P&L, around 16 plus 0.25, 16.25 will be amortization. Other than that, 7 lakhs as other expenses, legal cost, and 2% of 10 lakhs in the first year, 20,000 as other royalty expense. So when I look at my final extract of my balance sheet, goodwill will be 3,20,000 and franchisee will be 64 and 225, so that is 6625. In income statement, depreciation and amortization will be 1625, and in other expenses, franchisee fee and legal expenses will come at 20,000 and 7 lakhs respectively. So I guess that kind of wraps up the important questions of this chapter and a quick revision for this chapter. I hope this video has been helpful for you. If yes, please do press the like button, and if you need any other videos or you need any other clarifications, please feel free to comment and let us know, and I'll try to kind of upload the videos for the same. So keep studying, keep working hard, and I'll see you soon. Have a good day. Bye bye. Take care.